Good morning. Welcome to the Business Standard Morning Show. I'm Debari Sanyal. It's the 27th of July 2023, and here are the questions we'll be answering today. What does demerger of hotel business mean for ITC? Are the days of cheap Russian crude over for India? Why are analysts wary of textile stocks? And what is demerger? Cigarettes to hotels conglomerate ITC has decided to hive off its hotels business into a separate entity. ITC management has kept 40% ownership with itself and 60% will go to existing shareholders. So what does the demerger of the hotels business mean for the new entity? And what does it mean for the diversified conglomerate? Also, how will the move affect investors? Bhashwar Kumar does a deep dive.
On July 24th, FMCG giant ITC announced that it had received in-principle approval from the board of directors to demerge its hotel business. The new entity, called ITC Hotels Limited, will be incorporated as a wholly owned subsidiary of ITC Limited. While the conglomerate will hold a 40% stake in it, the company's shareholders will directly hold the remaining 60% proportionate to their shareholding. The demerger will take place under a scheme of arrangement, which shall be placed for approval before the board at its next meeting on August 14th. ITC runs 120 hotels in India, but the hospitality sector accounted for just 4% of ITC's revenue and 2% of its earnings before interest and tax in FY23. However, it accounted for about 11% of capital expenditure during the same period. The initial assessment by experts and media reports has been that ITC will see strengthened finances and improved capital allocation as a result of the demerger. For the full FY23 period, ITC's revenues were up by about 17% at about 76,500 crore rupees, while net profit was up by about 26% at about 19,190 crore. And ITC's fourth quarter year-on-year jump in consolidated net profit was led by growth across the cigarettes, FMCG and hotels segments. In hotels, the performance of the company, led by Chairman and Managing Director Sanjeev Puri, was backed by a focus on premiumization, cost optimization and an asset-right strategy. And the hospitality segment saw a stellar recovery, with pre-tax profits at over 200 crore rupees in Q4 FY23, compared with a loss of almost 30 crores in the year-ago period. And in a coincidence of sorts, on July 24th, the day the demerger announcement was made, ITC surpassed Hindustan Unilever to become India's most valuable, fast-moving consumer goods stock after a gap of over 4 years. For its part, ITC has said the demerger will attract investors and strategic partners that are aligned more sharply with the hospitality industry to its new hotels entity. The company adds that it will unlock the value of the hotels business for shareholders. The proposed demerger of its hotel business could reduce ITC's capital expenditure burden. In a report on 25th July, analysts at Nomura Financial Advisory and Securities India said the demerger would free up earmarked annual capex of about 200 crore to 300 crore rupees for ITC. They added that the demerger could also lead to surplus cash saving, along with higher dividend payout to shareholders in the medium term. Overall, analysts believe that the demerger will boost ITC's capital efficiency ratios and return on capital, with one IIFL analyst saying that the former will go up by almost 20 percentage points. However, the immediate reaction from investors was not encouraging. Shares of the conglomerate declined nearly 6% in 2 days after the management announced the demerger plan. However, they bounced back on July 26th, rising 2% to 470 rupees level. According to Nomura analysts, investors are worried that it is not a clean demerger and that value unlocking could be hampered potentially. Against this backdrop, what do experts think the proposed demerger means for ITC and shareholders?
ITC market cap is close to about 6 lakh crores. And ITC Hotels, the demerged entity, is expected to have a market cap of about 25,000 crores. So, which actually means that we are talking of about 3.5 to 4% of the ITC market cap. So, actually, this should not really move the needle for the shareholders. Looking at the structure which has been announced by ITC, that 40% will be held by ITC and 60% will be given to the shareholders, which actually means 15,000 crores worth of equity would be given to shareholders. And mind you, this is less than the dividend they paid last year. Last year, they paid about 18,000 crores as dividend. So, like I said, it should not move the needle, but overall, it should be sentimentally be positive.
The initial reaction in the share price was just a temporary reaction. And the ITC share, because of its basic value and its very high quality of management and governance, will come riding back. The profitability of ITC standalone without the hotels will rise compared to this year, quite obviously. There has never been a better time for hotels than it is today. India is on an absolute upsurge. Inbound tourism has gone up tremendously, and Indians themselves are holidaying like never before. And therefore, this could not have come at a better time. I actually see a fantastic value in this whole demerger. I'm actually very bullish about it.
One area that is being viewed with concern is how the new hotel entity's capital expenditure will be funded after the proposed demerger. So, what are the challenges for ITC going ahead?
No, I don't really see any major challenges as such. Once it's demerged, ITC hotels will have to manage their capex on their own. And it will free up a decent amount of cash for ITC as such, which can be put in the other verticals which they have, especially retail, which still guzzles cash as such. Looking at the hotels, the future business is going to be more of asset light. So I really don't see too much of a capex requirement by ITC hotels, and whatever they require, I think they'll manage on their own.
Experts don't see any specific challenges emerging from the proposed demerger and view it as a positive development for ITC overall and its hotels business in particular. However, lingering investor concerns around the proposed structure post demerger should be addressed.
FMCG majors like ITC had a tough time last year when Russian tanks rolled into Ukraine. Prices of commodities like crude, sunflower oil, and palm oil had soared. But there was a blessing in disguise too. Post-Western sanctions, India latched on to discounted Russian crude. Of late, the discount has shrunk. And with Russian crude breaching the G7 price cap of $60 per barrel, there is a risk of Moscow's oil losing its sheen for Indian refiners. So, are the days of discounted Russian crude over for India? I decided to check in with the experts. In February 2022, when Moscow marched into Ukraine, India's crude import from Russia was almost zero. Volumes rose to 46 million barrels this month as of July 23, capturing 45% of the Indian market, according to data from Paris-based commodity intelligence provider Kepler. Urals, a high-sulfur sour-grade crude traditionally supplied to Indian refineries, accounted for 27% of the country's total crude purchases in 2023, according to ship tracking data. This is the first time that a country has accounted for over 40% of India's oil imports, climbing at a record pace of just 18 months. Shipments are likely to slow down now. Russian Urals jumped $2 to $3 above the $60 per barrel price cap set by G7 countries last week. This was boosted by strengthening in international benchmark Brent and additional export cuts announced by Russia. Russia is voluntarily cutting another 500,000 barrels a day of output next month, in addition to 500,000 barrels per day already committed, leaving less oil for China and India. Most of the cuts will come out of cheaper Urals, while shipments of premium light grades will be steady. This will have global repercussions, as well as a direct impact on India's oil trades.
Well, over the last few weeks or probably months, I would say it has been a very roller coaster ride for the crude oil prices. So largely, in the bigger scheme of things, I think macros are at play, and if at all China starts to contribute, the automobile industry starts to contribute once again, manufacturing starts to rise once again. It is going to be a very, very positive buzz for crude oil prices. I think prices are heading northwards, maybe $82, $85 for the Brent, or probably $80, $85, $82 for the WTI could be largely on cards. But is 100 on cards at the moment? No, that is not the side that we are looking at.
Indian officials say that the discounts on Russian crude have crashed to $3 a barrel after Urals turned expensive this month, potentially hurting purchases. Surging demands for Urals have shrunk discounts from $8 to $10 a barrel on a landed basis of European benchmark Brent to around $5 to $6 a barrel. So, what is the way forward for India's crude trade from Russia? Experts believe it might be too early to worry. Given India's huge oil purchases, even a difference of a few cents to a barrel is adequate for refiners, a refining official said.
We have been buying crude, other grades of crude besides the Urals above the price cap already. Payments wise, there aren't any restrictions. Having said that, a lot of the banks have taken a more conservative stance, and not because of their business operations overseas, they have not been providing this kind of funding. Is it time to worry? I don't think so, because though the discounts have come down, but considering that millions of barrels are processed at each refinery, the discount of even $1 or could have a huge impact on the profitability of the refineries in terms of GRMs, etc.
And what might be the alternate options for India's crude trade?
We are strategically placed in the sense that we are quite close to the Middle East, and we can always increase our crude purchases from the traditional suppliers such as Iraq and Saudi Arabia, etc., UAE, etc. And however, obviously the discounts would not be there from these suppliers. India is already in talks with them for more liberal credit terms, which used to get from Iran. Last year, we signed the crude purchase agreements with Brazil and Colombia. So diversifying the basket has already been there.
At the global level, China and the US will also play a major role in determining a future for crude prices. Both nations have pumped out large portions of their strategic petroleum reserves. They will now look to rebuild their reserves to restrain the rise of crude. Meanwhile, experts believe India has enough options under its belt to not worry about the rise in the price of the Ural crude. In all probability, Russia's move is temporary and the discounts might soon be back to their older levels, they point out. While on one hand, India opened its doors for discounted Russian crude, it imposed an 11% import duty on cotton. Domestic prices of cotton have surged over 70%. Domestic exports have crashed to a 19-year low as several mills faced cash crunch. And stocks of textile companies have displayed a mixed trend so far this year. So, will the situation improve going ahead? Or should investors stay wary of the textile sector? Lavisha Darad brings you a detailed report.
Textile stocks have exhibited a mixed performance this year amid high domestic cotton prices due to increased import duty. On a year-to-date basis, shares of Page Industries, VIP Clothing and Lux Industries have declined up to 13%, while Welspun India, Raymond and Arvind have surged up to 51%. In comparison, the S&P BSE Sensex gained 9% during the same period. According to MCX, prices of cotton have soared over 70% to 59,500 rupees per candy so far this year. Analysts therefore believe that the sky-high prices spell trouble for the textile industry in the first half of FY24.
Whereas between domestic and international cotton prices, decline in global demand due to recessionary conditions in the developed economies and high inflation and increased energy and freight costs. All this led to textile industry coming under severe pressure. These issues resulted in India experiencing its lowest cotton yarn exports in almost a decade. While we don't expect any major revival in H1 FY24, the outlook for H2 FY24 seems favorable.
Historically, Indian cotton prices have largely remained at par or lower than international cotton prices, said analysts at CareEdge Ratings in their recent note. However, they said that in fiscal year FY23, domestic cotton prices were 20 to 24% higher than global markets, resulting in decline in the competitiveness of Indian cotton yarn spinners amid government's restrictions on cotton import. Consequently, Indian cotton yarn exports hit a decade-low level of 6.6 lakh tons in FY23 as against exports of 13.8 lakh tons in FY22. That said, while overhangs for the textile industry are unlikely to diminish in the near term, expect large-sized companies to tide through the storm in the long haul.
Diversified textile companies with profitable other business segments and premium textile companies are doing well. Welspun India and Raymond are resilient even amidst challenges being faced by the industry.
Overall, analysts remain wary of textile stocks in the near term. However, they expect gradual improvement in the long haul if cotton prices reverse trend. On Thursday, July 27th, markets will react to the US Federal Reserve's interest rate decision.
He's making plans for an early retirement. Business Standard.
Staying with the markets theme, stocks of tobacco giant ITC rebounded about 2% on Wednesday after a 3-day losing streak. Investors, it seems, have finally seen some positives in the company's decision to demerge the hospitality business. Reliance too did something similar a few days ago when it demerged its financial arm. But what is a demerger and why do companies do it? Tariq Ahmed decodes it for you.
India's biggest conglomerate, Reliance Industries, demerged its financial lending arm recently. The new entity will be called Jio Financial Services. And just a few days later, India's largest cigarette maker, ITC, announced a much-awaited demerger of its hotel business. The new entity will be called ITC Hotels. But what is a demerger? Demerger is a term used to describe the process of breaking a company into components. The demerger can happen for many different reasons. The demerged entities will either function on their own or will be sold or will be liquidated to cease its operations. Usually, the conglomerates that offer several products and services demerge their units which are not part of their core business. This can help the company to concentrate effectively on their core business and strengthen the demerged entities by raising capital. Demerger also helps the big companies to ensure transparent capital allocation and helps the companies to specialize their operations. If one of the subsidiaries of a conglomerate is affected with either debts or legal issues, the demerger can help the company to deal with the issues without troubling the entire company. Sometimes demerger can be forced too. To end a monopoly, Governments may force companies to break up into different units. The most common way of executing a demerger is as a spin-off. Spin-offs allow the parent company to have shares in the new company for the loss of shares in the original company. Then there is partial demerger, where the parent company retains some stakes in the demerged company. But it is also possible that a demerged entity may never go for an IPO. Demergers can bring up complicated accounting issues, but it also can be beneficial in terms of acquiring tax benefits and efficiency. The recent demerger of Reliance's lending arm, Jio Financial Services, will help the company to concentrate on the non-banking finance space. By splitting up into 6 different legal entities, international conglomerate Alibaba was expecting to achieve better capitalization and increase its subsidiaries' competency.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.
A demerger is usually tax-free, and the demerged company does not attract capital gains tax. Well, that's all for today. For more news and analysis, please log in to business-standard.com. Thanks for watching.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.